What's up, YouTube? My name is Jeff. Welcome to my channel, Investing is an Art. Today we're going to be looking at a financial statement from Microsoft. I want to go over 5 key things that I look for whenever I'm evaluating a company's financials. These things basically are looking at the company's overall financial health. Of course, whenever you look at a financial statement, there's tons of different metrics to which to measure a company by. But I find that whenever you're looking at a bird's eye view at a company, these 5 key metrics will really let you know if a company's doing well or not. So let's dive on into it. First and foremost, we're going to be looking at the income statement, and basically we're going to be looking at revenues at the top. Revenues are basically the total sales that a company has. We're looking at an annual report, so this is total sales within a year. And we want to see this number growing year over year. That's how we know a company is making more money, more sales consistently year after year. So obviously we can look at the revenue. We can see 5 years ago they were making $91 billion a year. We'll look at the most recent statement here in 2021, and they made $168 billion in sales. So that is fantastic. That's growing at a record clip. A lot of people like to write Microsoft off as, one of the old dogs that's not really growing anymore, but obviously they are. Even with the unprecedented year we had last year, they are growing at a record clip. So next thing I like to look at also on the income statement is the gross margins. You'll find that right here under the gross profit. Basically the margins is what a company retains per dollar earned. It really varies per industry what an average gross margin will be. Generally in a software company, which Microsoft is, they'll have much higher gross margins, somewhere in between the 50 and 60% mark, and even then they are clearly beating the industry average margins here, closing in at 70% margins, which is almost unheard of. So for every dollar earned, they are retaining quite a bit of that, which is fantastic. You want that. That way they can, either pay it out in dividends, they can do some more R&D so they can create new products and further create or increase the revenue year per year. All right, last thing we're going to be looking at on the income statement is the net income. This is the total amount of money that is left over whenever you subtract all these other expenses. And we also want to make sure this number is growing consistently year over year, just like the revenue. So obviously we can see back in 2016, they had a net income of $20 billion. And as we go through, we can see in 2021, they had a net income of $61 billion. So over the past 5 years, their net income has gone up quite substantially. You will see a little bit of an anomaly here in 2018. Sorry about that. So you can see that they went from $25 billion in net income all the way down to $16 billion. So that's a pretty substantial drop. But whenever you see a random anomaly like that, there's generally a reason behind it. It could be that the company made a purchase, they sold something, they had to write something off. Something explains that number. And being that it's Microsoft and every other year besides that one that it's consistently growing, I'm not too worried about that. So that's the main things I'm going to be looking for on the income statement. Next, we're going to go to the balance sheet. And on the balance sheet, there's one thing I want to see is to see if they have more assets than they do liabilities. Total assets basically is the total value of the company. And then we can see that they have $333 billion in total assets. And if we scroll on down, we have total liabilities. They have $191 billion in liabilities. So a good thing to look at whenever you're evaluating a company is to see if they have more assets than liabilities. If a company had to liquidate all their assets, they would have more than enough money to cover all their debts, which is fantastic. You want that. You really don't want a company that has more liabilities, more debts than they do in assets. Whenever you look at the assets here, you'll actually see cash and equivalents, inventory, which is obviously a big one, receivables, and then as you get further down, total liabilities, you'll have long-term debt. Generally, you want long-term debt in a company. Short-term debt is where a lot of companies get in trouble. Any big company, especially mega tech stock, they're going to have operating debt, which is perfectly fine. And then that's going to do it for the balance sheet for right now. And then we're going to go over to the cash flow statement. There's really only one metric that I look at on the cash flow statement, and that is the actual cash from operations. And this is the cash brought in from normal business endeavors. Basically, on the other financial statements, there's ways to manipulate those numbers to make them look a little better than they really are. So whenever you look at the cash from operations, it really gives you a pretty firm idea of how much cash the company is bringing in year over year. So as we can see, this number is also growing, which is fantastic. A lot of times, depending on the company that you're looking at, you can see that the revenue and the net income might be increasing, but all of a sudden you go over to the cash from operations and the cash flow statement, and there's some weird anomalies there. So you kind of have to dive in further and see what's going on. Me personally, when I'm evaluating a company I want to hold for the long term and put it in my retirement portfolio per se, I don't really want to be playing with companies like that. I want consistently to find companies that are growing their revenue, they have good margins, they have good net income, they have more assets and liabilities, and also that you can see on their actual cash flow statement, their cash from operations is increasing year over year. So those are the 5 things that I really like to look for whenever I'm evaluating a company. If you guys would like to get access to this software I'm using right here, it's called Tykr. It is free. It doesn't cost you anything. It's a web-based software, so you don't actually have to download anything. It is in a beta phase right now, so you do need a referral code, which I'll have linked down in the description. It is pretty cool just because it has tons and tons of information here. You can also go pretty far back in time as far as the actual financial statements go, which is really nice. I used to use Yahoo Finance. There's a few other ones out there where they work, I guess, but you're kind of limited in what you can see. They keep on trying to, upcharge you so you can get the premium information and all that. So it's kind of lame in that aspect. But I've had really good success with Tykr so far. Information seems to be completely accurate. It's really nice over here on the left-hand side, company overviews, news. You got the detailed financial statements that we just looked at, valuations, all sorts of different metrics in which to value the company. This is the only software that I'm aware of that actually has this, which is really nice. You can see analyst estimates, call transcripts, which is pretty cool. So if you don't have time to necessarily listen to a long, drawn-out earnings call, you can read through it real quickly and just kind of catch the highlights. But yeah, it's a really cool software. I would definitely recommend using it. And again, you can get that referral code down in the description. I don't get anything for it. Again, it's completely free. I just wanted to throw that out there as a good alternative to some of the other less than desirable, I would say, apps out there. Let's just leave it at that. But anyway, if you enjoyed this content, found it useful in any way, hit the like button. This is my very first video that I've ever made. I'll be hopefully getting a video camera and getting my face on the YouTube. But in the meantime, I'll log off. Appreciate it, guys.